Before money, there was bartering. People traded goods and services directly. A farmer might trade a bushel of wheat for a pair of shoes from a cobbler. This system had limitations. It relied on a double coincidence of wants. Both parties had to want what the other offered. Gradually, commodity money emerged. These were valuable goods used as a medium of exchange. Cattle, grain, salt and shells were early forms of money. Eventually, gold and silver became the preferred commodity money. They were durable, divisible and rare. Commodity money simplified trade. It provided a common measure of value. However, it was not without its drawbacks. Storing and transporting large quantities of gold or silver was cumbersome. The development of paper money was a significant innovation. It started with goldsmiths. These artisans stored valuable metals for safekeeping. They issued receipts to depositors. These receipts began circulating as a form of money. People traded them as payment for goods and services. Goldsmiths realized they could lend out some of the deposited gold. They issued more receipts than their actual gold reserves. This was the early stage of fractional reserve banking. Modern banking operates on a similar principle. Banks create money by lending out a fraction of their deposits. This process increases the money supply. Today, most money exists as digital entries in bank account. Money is the lifeblood of an economy. It circulates through transactions, facilitating trade and driving economic activity. When money flows smoothly, businesses thrive. They invest, hire workers and produce goods and services. Consumers earn income and spend it on goods and services. This spending generates revenue for businesses, which in turn pay wages and purchase inputs. A healthy circulation of money is essential for economic growth. The supply of money in an economy is crucial. Too much money in circulation can lead to inflation. This is a general rise in prices for goods and services. Inflation erodes the purchasing power of money. Governments play a role in managing the money supply. They can influence interest rates through central banks. Governments also borrow money by issuing bonds. These are debt securities that pay interest to holders. Bond issuance allows governments to fund spending. However, it also increases the national debt. Taxpayers ultimately bear the burden of repaying this debt. Balancing spending, borrowing, and economic stability is a constant challenge for governments.